All right. So basically, this is what the stock's been doing for the past year. It's down 49.87% for extreme networks. So, and it's been spiking down and down and lower and lower. Kind of ridiculous. So it looks like it's priced at $5.63. It's basically the stock market. All the traders are betting that this company goes under, that they go out of business, and they fail completely based on their stock performance. But then you pull up their history of their company's performance and stock valuations. So let's look at the stock valuation first. Pull up the full company report on Zacks.com, which my internet's going slow, but here we go. It's priced at 0.66 price to sales and 9.7 price to earnings. So it's pretty low. That's on average for the sector. It's probably, I mean, it's hard to estimate, but maybe like an 8% revenue growth stream of organic revenue growth for this kind of price. Maybe even a little lower than that. So it's priced like a very slow growing company that's failing. If you look at their earnings chart, this is earnings per share. It's just been slowly increasing since mid 2015. So it's showing healthy earnings growth for the past 3 years. You go to revenue growth, and this is where it's interesting. You want to cross-reference revenue growth with acquisitions. So they were losing revenue. They were decreasing in their revenue in mid 2016, and then come June 2016, the revenue stream started increasing, and ended at 28%, 27.99% in June of 2017. So 1 year later, their revenue growth stream ended at 28% roughly. So you look at what happened, you pull up their acquisitions. I always look at investments first. There's an investment in year 2000, so it has basically no relevance to this revenue growth curve. Then you pull up their acquisitions, and the acquisitions that are relevant: September 2013, September 2016, March 2017, March 2017. So then look back at the revenue growth curve. 2013 acquisition, this is what this spike in the revenue growth curve is accounted for. So that acquisition made the revenue growth spike, and then it dropped after the period in time when they were calculating in the added revenue from that acquisition. I assume that's what this spike is from. And then it comes back down to zero, so they have no organic growth. It's seemingly an unhealthy acquisition because they're declining in revenues afterwards. So maybe the company they acquired had declining revenues and they purchased them for some other reason. But then in 2016, they peaked into positive revenue growth in early 2016 for the first quarter, it looks like. And then they dipped back down. And then their acquisition, then they started growing again. So revenue started growing slowly, increasing after October of 2016. So they made this acquisition in 2016. It was in September. It was for $55 million. So $55 million isn't a huge chunk of their company. They're priced right now. If you go to the full company report, you look up market capitalization, they are worth $648 million. So $55 million is a decent size, but not a huge chunk of their total value. So it shouldn't have really affected their revenue growth stream too drastically. And you don't see a spike in the graph that is attributed to an acquisition that has a large amount of revenue already acquired, or that they're just adding to their revenue. So this revenue growth beyond, starting in late 2016, seems to be organic revenue growth, ending in mid 2017 at 28%. Seems to be organic revenue growth. And in articles I read, the CEO clarified that they do have organic revenue growth, This is what that increase right here is. Maybe from the health of that acquisition they made that allowed them to gain interest in other customers coming to them. Maybe from other things, but this is organic revenue growth starting in late 2016 and ending in mid 2017, where it's untrackable anymore because of the other acquisitions they made. So they made 2 other acquisitions in 2017, March of 2017. Brocade for $55 million and Avaya for $100 million in 2017, March of 2017. So that's back here. The acquisitions most likely didn't complete until this spike in the graph. So they didn't see the revenue from those acquisitions affect their revenue until third quarter 2017, where it boosted their revenue growth to 72%. So that's from adding revenue from those acquisitions. So you can't value their organic revenue growth anymore because it's skewed by the revenue added from the acquisitions. So this lasts for a year until it's until you're able to compare it again. So that's what this is right here, 56% in quarter 4, and then 76% again in quarter 1, 2018, and then we're down to 55.73% in quarter 2 of 2018. So next quarter earnings is super important. They're hopefully going to stay above 15% revenue growth, hopefully from showing organic revenue growth. Hopefully those acquisitions were healthy. The acquisitions may have actually negatively affected their organic revenue growth if they were companies that had declining revenue growth by themselves. So it might drop down, but they ended their organic revenue growth at 28%. So my hope is that it shouldn't be too negatively affected and it should still be above 15% revenue growth, which means that if it stays at next earnings report above 15% revenue growth, then that means that their company is drastically undervalued. A company with that kind of revenue growth, with their kind of margin. So I pull up their company report and they have a 10K annual report, which shows their revenue, their balance sheet, their income statement, and their statement of cash flows, which are all important documents. So I scroll down. Actually, it's the 10K, I forgot. So I'm just going to search for financial statements and supplementary data. It has all of them right here. I first look at their balance sheet. Check out total current assets. They have, since it's in thousands, 400 and rounding up to 428 million compared to their current liabilities, which is at 300 rounding up 360 million. So they're not in a capital deficit. They have money to spend as of June 2018. They have money to spend on acquisitions still if they wanted to make more acquisitions into the future. And they aren't in a capital deficit, so they have enough cash on hand to pay for their current liabilities. If you look at long-term assets to long-term liabilities, they have 770 million compared. Well, they don't have it totaled. I could add it up. It's like 190. Like 670 compared to 770. So they have more assets to cover their more total assets to cover their long-term liabilities. It's worth noting that they have a healthy balance sheet. And then you look at this kind of just adds to their argument is their consolidated statement of operations. So one of their income statement. You look at where their revenues are coming from, product revenues. I should have percents, but scaled drastically from 2016 to 2017. And then they almost doubled from 2017 to 2018. That's a huge increase. But what's more important is looking at cost of revenues. So for products and services, you compare, it's 50%, which is a pretty big number. It's roughly 50% of their revenues they have as costs, which means it gives them less allowance to spend on research and development, sales and marketing, and general and admin costs. So if you look at those expenses, research and development has essentially doubled in the past year. So they've doubled the amount of spending on research and development from 2017 to 2018. So they're investing in future potential growth in the company. And sales and marketing, which is really important too, has gone up by a large portion. I'll do the math real quick. If I can get my password to go. 267 minus 163, we'll round up, divided by 163. So they've increased their sales and marketing by 63% and doubled research and development. So they're investing heavily in the future of their company, which strengthens the argument that organic revenue growth is potentially in store for them during next earnings report. Again, making the company drastically undervalued. I think they could double, triple, or even quadruple over the next 15 months, which is why I'm looking to buy. And I also, on top of that, think that the market is severely undervaluing them as a company. So you can buy these call options for ridiculously cheap for 15-month periods, long periods of time, or for the 6-month period, because that's fairly cheap also. Right now, it's actually really cheap. It went down today quite a bit, even though the stock went up. I think the stock will continue down until at least a week before next earnings. So I think it should be safe to buy the options until then, and then hopefully they should spike up after earnings, but potentially they could stagnate for another few months or so until the market catches up. But I think that the 15-month call options at $7.50, looking for a 75-cent price range, is a really good buy. Huge opportunity in the market right now.